Have you ever wondered how to transform your debt into wealth? Is it even possible to perform such financial alchemy? Welcome to the world of finance, where the impossible becomes probable with the right strategies. Today we're diving into the concept of transforming debt into wealth. Yes, you heard that right. Debt, the ominous cloud that hangs over many of our heads, can actually become a stepping stone to wealth. Most of us are taught to see debt as a financial pitfall, a burden that hinders our journey towards wealth. It's a common misconception, but it's not entirely accurate. Debt, when managed well, can be a catalyst to wealth creation. We're also going to challenge the popular belief that wealth is unattainable for those in debt. Wealth isn't just for the privileged few, it's achievable for anyone ready to embrace financial discipline and wise decision-making. So, let's debunk the myth and explore the secret of financial alchemy. To transform your debt into wealth, first, you must understand what debt is. At its core, debt is an amount of money that is owed or due. It's an obligation, a promise to pay back the amount borrowed, often plus interest. Now, that might sound a bit ominous, but debt isn't inherently evil. In fact, it's a tool, a financial instrument that, when used wisely, can help us achieve our goals. Now let's delve into the two main types of debt: good debt and bad debt. Good debt is an investment that will grow in value or generate long-term income. Think of a student loan. You're borrowing money to fund your education, which in turn is expected to increase your earning potential in the future. That's good debt. On the other hand, bad debt is debt that you incur to purchase things that quickly lose their value and do not generate long-term income. This includes things like high-interest credit card debt from buying the latest gadgets or taking lavish vacations. These are things that may feel good in the moment, but they're not contributing to your financial growth. The key to using debt effectively lies in understanding the difference between these two types of debt and being strategic about how you use them. For instance, taking on good debt to invest in your future can be a smart move. But taking on bad debt without a plan for repayment, that's a recipe for financial stress. Debt impacts your personal finance in various ways. It can help you build a good credit score, which can open up opportunities for more favorable interest rates on loans and credit cards. However, too much debt can lead to financial instability, stress, and a lower credit score. So managing your debt effectively is crucial. It's about striking the right balance between leveraging debt to achieve your financial goals and avoiding the pitfalls of excessive or unnecessary debt. Understanding your debts is the first step towards financial freedom. Now that you understand your debt, the next step is to start saving. Savings, my friends, are the lifeblood of financial stability. Picture your savings like a well-crafted lifeboat, ready to keep you afloat during unexpected stormy seas. This is the power of savings. It's not just about having extra money in your pocket, it's about creating a safety net that can catch you when you fall. And believe me, we all stumble at some point. Let's dive into the concept of an emergency fund. This isn't money to splurge on the latest tech gadget or a spontaneous weekend getaway. No, this is your rainy day fund, the money you set aside for those unforeseen expenses that life tends to throw our way. Car repairs, medical bills, or even an unexpected job loss. These are the rainy days for which your emergency fund exists. Aim to have at least 3 to 6 months' worth of living expenses stored away in your emergency fund. It may seem like a daunting task, but remember, Rome wasn't built in a day. Start by setting small, achievable saving goals and gradually work your way up. Speaking not of goals, let's talk about savings goals. These are the financial targets you set for yourself, whether it's for a down payment on a house, your child's education, or that dream vacation. Savings goals give your money a purpose. They motivate you to curb your spending and foster a disciplined approach to managing your finances. And the best part? Watching your savings grow is an incredibly rewarding experience. But how does saving help in debt reduction, you might ask? Well, having a healthy savings habit means you're less likely to rely on credit. While saving is important, smart investments can accelerate your journey from debt to wealth. Investment is a little like planting a seed. You put in a little upfront, nurture it with time, patience, and a touch of luck, and eventually it grows into something much bigger. But instead of a tree, you're growing your wealth. Investment is essentially putting your money into something with the expectation that it will generate an income or appreciate in value over time. It's your money working for you, rather than you working for your money. There are many avenues to explore when it comes to investing. Each has its own potential returns and risks, and it's important to understand these before diving in. Firstly, let's talk about stocks. Buying a stock means buying a piece of a company. If the company does well, the stock's value goes up. and you make a profit when you sell. The stock market can be volatile, but over time, it has proven to provide substantial returns. Bonds, on the other hand, are a safer bet. When you buy a bond, you're essentially lending money to a company or a government. In return, they promise to pay you back with interest after a certain period. The returns are usually lower than stocks, but so is the risk. Real estate is another popular investment option. Buying property and renting it out can provide a steady stream of income. Plus, the property itself can appreciate in value over time. And let's not forget about mutual funds, where your money is pooled with that of other investors and managed by a professional. This can be a good option if you're new to investing or don't have a lot of time to manage your investments. Remember, diversification is key. It's not wise to put all your eggs in one basket. Spreading your investments across different types can help manage risk and increase potential returns. Investments are the tools that can help you build your wealth while you sleep. With a bit of knowledge, patience, and smart choices, your journey from debt to wealth can become a reality. Paying off your debt is crucial to your financial transformation. But how do you do it efficiently? Let's dive into some strategies that could make this process more manageable. First off, we have the snowball method. This strategy involves paying off your debts from the smallest amount to the largest, regardless of interest rates. The idea here is to gain momentum, much like a snowball rolling down a hill. You start with the smallest debt, and as you pay each one off, you roll that money into the next debt. The advantage of this method is the psychological boost it provides. You see results quickly, which can motivate you to continue. However, the downside is that you might end up paying more in interest over time, as larger debts with higher interest rates are left for last. Next, we have the avalanche method. This strategy is the opposite of the snowball method. Instead of starting with the smallest debt, you start with the debt with the highest interest rate, regardless of the amount owed. The advantage of this method is that it saves you money in the long run as you're tackling high-interest debt first. However, it might take longer to see results, which could impact your motivation. Lastly, there's debt consolidation. This involves combining all your debts into one larger debt, often with a lower interest rate. This can simplify your payments and potentially save you money. However, it's important to note that this strategy requires discipline. It's easy to fall into the trap of racking up more debt once your individual debts are consolidated. Each of these strategies has its pros and cons, and what works best will depend on your personal financial situation and mindset. It's vital to assess your debts, your income, and your financial goals before deciding on a strategy. Remember, paying off debt is more than just a financial exercise. It's a commitment to your future self, a step towards financial freedom. Choosing the right debt payment strategy can make your journey to wealth much smoother. Transforming debt into wealth is not just about numbers and strategies, it's also about mindset. The journey to wealth is a lot like a marathon. It's not just about the distance or the speed, it's also about the mentality. It requires persistence, discipline, and a positive mindset. You see, your mind is a powerful tool, and it shapes how you perceive and interact with your financial situation. Those with a wealth mindset see opportunities where others see obstacles. They view debt not as a burden, but as a stepping stone to financial freedom. Setting clear, attainable financial goals is a key part of this mindset. These goals act as your roadmap, guiding you on your journey to wealth. They help you stay focused and disciplined, avoiding unnecessary detours or setbacks. Remember, the mindset of wealth is not about having money, it's about mastering money. With the right mindset and the right strategies, you can transform your debt into wealth.